In this presentation, we are going to look at what we call a replacement analysis, and that is part of a capital budget analysis, a very important task that companies must do in order to figure out if they want to replace a piece of equipment or something when they're looking at a new project. The question that we're looking at, and I quote from the textbook, the Gare Company is considering the purchase of a new machine tool to replace an obsolete one. The machine being used for the operation has both a book value and a market value of $0. It is in good working order, however, and will last physically for at least another 10 years. The proposed replacement machine will perform operations so much more efficiently that Gare engineers estimate it will produce after tax cash flows, which are cost savings, of $9,000 per year. The new machine will cost $40,000 delivered and installed, and its useful life is estimated to be 10 years. Its expected salvage value is $0. The firm's required rate of return is 10%, and its marginal tax rate is 40%. Should Gare buy the new machine? So let's look at the different items that we need to look at, and then later on we'll look at the calculations in order to determine if this company should purchase the new machine or not. Valuation. This is described in our textbook in this quote. If a firm invests in a project with a present value greater than its cost, the value of the firm will increase. So this helps a company assist in the capital budgeting process and analyzing and determining what route to take. Relevant cash flows. Cash flows, the actual cash as opposed to accounting profits that a firm receives or pays during some specified period. So we don't look at the accounting profits, we look at the actual cash flows. Capital budgeting decisions are based upon cash flows after taxes. So there are a few different problems that arise when looking at this as well. And these are as follows. Sunk costs, which are explained as a cash outlay that already has been incurred and that cannot be recovered regardless of whether the project is accepted or rejected. So in this case, the company is using perhaps in a consulting firm or something of the such to look into the new equipment, find different pieces of equipment, the costs, shipping costs, all of that kind of stuff. That money's already spent, so that cannot be analyzed and added into the capital budget decision. An opportunity cost, the return of the best alternative use of an asset, the highest return that the firm will forego if funds are invested in a particular project. So, looking at the different options and what opportunities could arise from those costs. Externalities, described in our textbook as the way in which accepting a project affects the cash flows in other parts of the firm. So, how will these new costs, whether they be profits, losses, etc., how will that affect the rest of the company? Generally, a company is not focused on one sole project, whereas there are many projects going on. And then, of course, we have to look at shipping and installation costs, and also inflation always needs to be a factor. The initial investment. The initial investment outlay refers to the incremental cash flows that occur only at the start of a project's life. It includes such cash flows as the purchase price of the new project and shipping and installation costs. In this question, the initial investment is the $40,000, which the question gives us is the cost of the new piece of machinery, and it also includes the shipping and installation costs. The supplemental operating cash flow. This is described as saying supplemental operating cash flows are the changes in day-to-day operating cash flows that result from the purchase of a capital project. They occur throughout the life of the project, continuing to affect the firm's cash flows until the firm disposes of the asset. This is what we're going to look at in further detail later in this presentation. The company needs to estimate, analyze how much money is going to be flowing in and out, and that way they can determine if this new project is worthwhile or not. terminal cash flow. The terminal cash flow occurs at the end of the life of the project. The net cash flow that occurs the end of the life of the project, including the cash flows associated with 1, the final disposal of the project, and 2, the return of the firm's operations to their state prior to the project's acceptance. So any money, at the end, if they needed to actually get rid of a piece of equipment, if there were costs entailed after the life of the equipment, or anything such as that can be factored in as well, or perhaps the sale of the piece of equipment at the end of the life that they plan on having it. Replacement analysis. So let's get into what we're actually looking at. As our textbook quotes, identifying the incremental cash flows is more complicated with a replacement project than with an expansion project because the cash flows from both the new asset and the old asset must be considered. The incremental cash flow is the change in a firm's net cash flow attributable to an investment project. So in this case, we're looking at a replacement analysis. The Gare company is trying to decide if they want to replace their current piece of machinery that's still working fine with a new piece of equipment that they are estimating will save them $9,000 a year, which is a profit for them, a cost savings. So our data, let's look at this a little closer. The old machine has a book and market value of $0. It, however, still works well. The company estimates that it could work well for another 10 more years. What they don't provide us with is their cost of maintenance, upkeep on this machine since it is getting older, and different things like that. That's not provided in this question. The new machine, the cost is $40,000, and it does state that this includes the shipping and installation fees. The predicted life of the machine is 10 years. The cash flows predicted are a cost savings to the company of $9,000 per year for the 10 years. The company's marginal tax rate is 40%, and the estimated salvage value is $0 at the end of the 10 years for this new piece of machinery. So let's look at our problem solving. What I've done here is I've used Pages, which is the iMac version of Excel for Microsoft. And first we look at the cost of the new asset, which you can see underneath year 1, which is $40,000 negative because that is a cash outflow for the company. The change in the operating income for the next 10 years is, as the question states, $9,000. We then look at the change in depreciation. This we used the table in our textbook on page 546. We assume that we are using the graph of the 10-year life of a piece of machinery, and use the percentage rates to calculate the change in depreciation. The change in operating income, we are then taking the change in operating income and taking the change in the depreciation and coming up with our results. As you can see, year 1, $5,000, year 2, $1,800, etc. Then we go into the change in taxes. So we consider the fact of the 40% marginal tax rate, and that it is a cost, the asset cost of $40,000. The net operating income after taxes is then calculated, as you can see, and eventually we are able to calculate the supplemental operating incomes. These are what we're going to use in a couple of slides to calculate the IRR, which we will discuss further. But this graph right here shows that we were able to calculate the supplemental operating incomes, which we needed first in order to continue to solve the problem. The internal rate of return, otherwise known as what I said, IRR, is described as the discount rate that forces the present value of a project's expected cash flows to equal its cost. What the textbook continues to say is for a decision rule for a company to look at, a project is acceptable if the internal rate of return is greater than the rate of return needed. In this case study that we're doing, the rate of return needed is 10%, as stated in the question. So now we look at the IRR data. I also use the pages, the Excel version of the spreadsheet, to estimate the IRR, the PV, and the NPV, the present value and net present value. So we can see that the rate of return needed is 10%. Present value we calculate out using the spreadsheet to $43,787.10. The NPV then shows as $3,787.10, and this generates us as an IRR of 12.27%. So we need to keep this in mind, 12.27%. We needed a rate of return of at least 10% for the company to make money. So our answer can simply be yes, the company should and could purchase this new piece of machinery. The new piece of machinery will be more efficient, as the question states, and it is going to generate a more positive rate of return than is needed or that was expected in the beginning. We can keep in mind, certainly, that the old piece of machinery, if the company chose not to purchase it, it is still working. It is already at a market and book value of $0, so they cannot sell it at this point and make any kind of profit. What we do need to also keep in mind, this new piece of machinery, it's estimated in the 10 years will have a salvage value of $0. Again, we're not given the cost of the company needing to get rid of the old piece of machinery. Also, it does not discuss if there are any costs in training the employees to the new piece of machinery, or if they need to make any additional purchases, storage space, supplies, whatnot for the new piece of machinery. We're just going by what the amounts are given to us in the questions. And here's a list of my references from our textbook that I used for this presentation. Thank you so much. I hope you guys enjoyed this, and I look forward to more in the future. Thanks.